Good morning. Happy Friday. Here we are. Nice look below and fail of yesterday's low, eh? Early in Globex. That would have been a nice trade. And let me show you why on the next chart. The look below and fail trade it's one of the well it's a fundamentally basic trade, eh? And there's a business reason for it. The sell orders take you underneath a level, then those sell orders are done. When those sell orders are done, the market takes back that level. So you wait to see whether that level holds and then you buy it and you put your stop underneath that level and then sell into the strength. And it works on all time frames. Now, there are certain places to take it. You don't take it at random places. You take it at an edge. Here it is here. Look below and fail of 73.79, right? Look below and fail of the previous day low. There's a reason why you take the trade at specific places because there is a likelihood that there's going to be buying there. Why? Because on liquidation, shorts will come in and cover. Right? Smart money shorts will be covering here. Wholesale will buy on top, and then retail and the shorts who shorted down here will push price up. So there's really four sets of buyers in the look below and fail trade. And that's what you want. You want follow through, right? So tonight now overnight inventory is long, okay? Inventory is long. It's above the close. The overnight high is really close to 91. Where is it? 88 and 3/4. Right? No, I didn't take this idea from ICT, man. I've been around a lot longer since ICT. I've been around for 34 years, my friend. I've been making markets for 20 of those years and selling billions of shares of stock into US markets. You know, but there's a mechanical reason for the trade, right? That was funny, wasn't it, Charles? ICT. That guy's got a good cult going. He's got a good cult going. I got to give props to that guy, you know. It's like the Hare Krishnas or the Moonies. He's got a lot of people believing his thing. Good for him. You know, marketing is a beautiful thing. So that overnight high is just shy of 73.91. What I'm doing is I'm looking for a look above and fail or a fail to take out that 73.91 and a move back down. Now, if we accept over 91, then be careful shorting it for all of you who are trading longer time frames. So when we came down and took out the previous day low, which was a poor low, you'll notice the next half hour bar cannot trade at the previous day low. That's your signal. So what you're doing is you're going long here and you're putting your stop here. And then you sell into the strength that is created by a lack of supply, right? So that's what that trade is based on. Same thing, you always take it at an edge. You don't take it where just randomly, right? You wait for an edge because the edge is where you get the best deal, where you get the most buyers, right? So it's very simple. It's easy to understand. So you don't have to make a big deal with indicators and all this stuff. It's simple trading. It's the way people have been doing this look below and fail trade for hundreds of years. Jesse Livermore talked about it 100 years ago. Guys like Addison Jerome, Vanderbilt, all those guys, you know, they did the same thing, right? It's based on fact and business. The reason is, I'll go through this with you guys because none of you guys ever get explained this. Say I'm a market maker, right? And Charles goes to me, hey, JJ, I want you to sell 1,000 contracts up here, right? And I'll go, okay, Charles, what's your limit? And Charles goes, oh, don't go any lower than 78. Okay. So I start selling the market down and tap, 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 tap. By about here, I might have 200 or 300 contracts left. I'll sell it down, and down here, I'll buy those 300 contracts in my own account. And I'll call Charles and I'll say, hey, you're complete. And Charles will go, where'd you get me out at? I go, oh, maybe 82. Great. That order is done. As soon as I buy those 300 contracts, I know the shorts who are short in this cost basis are going to come and start covering. So as soon as I see those buyers come in, I move my offers up. And they will chase. As soon as I move my offers up, retail will come and start buying. So the first sequence is smart money shorts come in and cover. Then wholesale will buy. Then retail. Now the fourth set of buyers that cause this move here, these are the dumb money shorts who follow price and short here and add here. By the time we get to here, they go, oh crap, we got to cover. They go to cover, and everybody who has the supply yanks it, and that's why we're distributing up here. This is something that has been going on for hundreds of years, right? Before all these fancy terms came around. We call it the look below and fail. Some people call it the catcher's mitt, right? It's a very, very similar thing. It doesn't matter what you call it, but basically all it means is the sell orders are done, the market's going to go up looking for a buyer, which is probably one of the hardest things for retail people to understand because they don't look at this as a market. They think that there's some god algo that controls it. No, it's just the business has never changed over thousands of years. Ever since the Amsterdam Exchange, the business hasn't changed. So once a sell order or a group of sell orders is complete, the market will move back up looking for a seller. That is a lack of supply. That is the reason why you buy. Your risk is very minimal if you wait for an edge too, because if you get stopped out, no big deal. So there's a reason why you put your stop here. Say you're long at 81, okay? You buy inventory at 81, hoping to sell it at maybe 84. Got it? Now, if somebody comes and offers it at 79, 78, then you know that your inventory is mispriced and you need to get out. Right? Is your inventory priced correctly? Right? If it's not priced correctly, you're not going to make money. It's like you're buying cars for 30% over retail and trying to sell them at 50% over retail, right? Doesn't make sense. Right? And that's, my friends, why they call it a market, which everybody forgets. Now, if you want to learn how to trade and make good decisions, come into our trading room. We've got a 3-day free trial. And also starting soon, we're going to be having a contest where you can make $5,000 by showing your trades. Real simple. So it's something that we are going to be doing very soon, right? And we'll give you the knowledge to, go out and be able to make a living, right? Instead of these rooms who charge you money, charge you for software, right? We keep the cost low. We interact with people and we try and teach them, right? So what are we going to do here? I'm waiting to see what happens when London opens. Now, this is a very common scenario. Those of you who've been with me for a couple of weeks, you've seen long inventory that really hasn't corrected lower, right? It takes a while, doesn't it? So what I'm really looking for is this 91 and a quarter. That's a big level for us. We've looked above it and failed a couple of times, right? Look above, fail, right? Now we're right close to it again. So what I'm curious is, do we find sellers at 91? Do we accept over 91? Because if you do this enough, when you do this, you're going to cut out all the supply. You will have taken that supply and flushed it out. So that's what I'm looking for. I'm waiting for London to show up and tell us if 91 is a sell or not this morning. Let's see what happens. This is a distribution cost basis. VWAP is way down here at 68, right? This is a distribution cost basis that I did my balance on. 74 to 79. And you double it. We were looking for 91 and a quarter. It worked out, didn't it? So let's see what happens here. That's a great question. What causes this melt up on very low volume? Here's the thing, you guys. If all the supply is owned at a lower price, it doesn't take much to move the market higher. We spoke about this yesterday on stream. Somebody said, oh, this move is on very low volume. And I was like, yeah, that's right. Because after you flushed out a market, George, it's really easy to move it all the way back up because there's no supply. Let me give you an example. When I do deals, say we sell 1 million shares of stock between $5 and $6. You with me? So I distribute 1 million shares of stock between 5 and 6. Now, when I take that stock underneath 5, people are going to sell. So if I take it down to, say, $3.50, maybe 60% of the people will sell out, right? Because it's a small stock, it's day traders, flippers, right? That kind of thing. Here comes London. Let's see. We have a poor high. So a lot of people will automatically short that poor high and put their stop above it. Okay? If you're doing that, then you want to go put your bids down here at 85. Okay? So when I take it back down to 350, I'm going to flush it out. I might have to buy 600,000 shares between 350 and 4. And there'll be 400,000 shares left to clean up. So if the client's in a hurry, I can go and buy it back a little higher, or I can sit there and bid it, take it down to 3, right? I'm sorry, I'm short 87.5. I'm just covering the 85s here. Just on a couple of contracts. And if I take it to, say, 3, I can maybe flush out another 200,000 shares. Now I've sold 1 million shares between 5 and 6. I buy them back between 3 and 350. You with me? So now that I've taken out 80% of the overhanging supply. Does that make sense? Because we control the supply. So now, once we own all that stock, we do another promotional campaign and start ripping it up. That thing will go from 5 to 7 like a hot knife through butter on very low volume. Because we've bought it all underneath. Make sense? I'm flat. Do you kind of understand, George? The ES is a market that has limited supply. There's no dilution in the ES, right? You with me, George? So if you buy back 80% of the supply that you sold, right? Don't just picture it, pretend you're selling apples or oranges and you're selling them and you're buying them back. Don't get all hung up about the mechanics of ES, right? It's very simple. Do you see this here? The supply from yesterday is here, and then we flush the market out. So there's that $5 and up. Here's the 350 down to 3, right? So we took out all the supply. We flushed the crap out of everybody when we took out that previous day low. Right? Everyone came puking out, and not a lot. Then right back up, we got a big short position here, right? We've got a large short position here. And straight up, and then you do a little distribution. That distribution brings buyers. And another distribution. Now we're putting it on sale. So I covered. If you're still short, I'd be looking for bids around 83 and let's see, 82 and a quarter, 82, right? People will say funny things like, "Oh, you're a supply and demand trader." Well, what else is there, right? People forget it's a market. And what I was talking about just now is buying retention. Now, sometimes in some markets you have very good buying retention, where people buy the stock and they put it away because they're buying it for an investment instead of a trade. That's why companies like Apple don't go down very long, because Apple doesn't dilute, they buy back stock. And what you're doing is you are selling to people who put it away and buy more when it dips. That is the concept of buying retention, right? Now, ES is a speculative market, so people are investing in ES. But once you flush the market out, you're flushing out all the cheap supply, buying it, and then reselling it. It's just like a used car lot. But if you control the supply, and ES, nobody's controlling the supply, it's just limited, right? The supply in ES is limited because it's based on the S&P, which is 7 stocks that compose, 35 to 40% of the S&P, that trade less than 1% of their floating supply. See, if you look at how markets are created, you will understand how they trade. The problem is nobody teaches how a market is created, because all these clowns out there who are teaching trading have never actually structured a deal and taken a company public and sold 300 million shares over a 3-year period of time. Once you've done that, you understand that how a market is built will affect how it trades. So if you have a stock like a penny stock where the insider's unloading stock every day, you will see it go lower and lower and lower. It'll have 1 billion shares in the float, and then 6 months from now it'll have 2 billion shares in the float. Now if you have a company with a 5 million share float, you can move that stock around very easily. Sorry, Dave, I don't understand your question. So when you're new, you should come into the room and learn about inventory and cost basis. So that's what we teach you, how the market is created. And you don't have to be an investment banker to know that a Ferrari is going to drive differently than a 68 Ford 150, F-150, right? You understand how that car is built for a certain task. The truck is built for a certain task. They drive very differently, right? That's really simple. So we teach you that in a market there's an inventory, right? An inventory of goods. In this case, it's ES contracts. that inventory has a cost basis. How much do people pay for those contracts and where are they selling them now? Right? Then our trades are based upon that. Our trades are based on common sense, which, you know, it's funny because, we look at this trading room and, you know, based on simple common sense, you'd think that there'd be 10,000 people in the room. But people would rather spend more money and have people sell them some confusing crap and all these concepts that don't actually work for the layperson. And they spend all this time trying to decipher what's going on while they're blowing up their accounts. What I'm trying to do is I'm trying to bring back common sense. It might be difficult. It's a hard sell. It's a really hard sell in this day and age because people love being lied to. They love being told stories and they love buying into anything that sounds kind of exciting and cool. So if you tell them this is all you got to do, they're like, "Oh, it can't be that simple." Right? It's not sexy enough, right? But if you go and tell them that, you kind of create a tall tale like, one night I was sitting there and this alien spacecraft came down and he gave me the alien gave me the algorithm on how the market works. People will eat that shit up, right? With two spoons. Yeah. So it's really easy to sell stuff that doesn't work, right? It's very easy people love being lied to. So that's what I'm trying to do is I'm trying to keep people from losing all their money, right? People love being lied to. What, the alien spaceship? There's this little green man. He told me how the market worked. And people eat that shit up with two spoons. They love being lied to. That's why Ponzi schemes work, right? People buy into that stuff. That's how Madoff made money for decades, lying to people, right? See, unfortunately, before I met all of you guys, I was happy taking your money. Before I had my heart attack, I was more than happy to just rob you guys blind because I'd never met a retail trader, right? I was an institutional guy, never spoke to retail people. I had never had a single client who said, "Hey, JJ, what stock should I buy?" My clients said, "Hey, JJ, there's 15 million shares of stock in the account we're sending to you. In 3 weeks, I want there to be none." Right? And they do a promo campaign. I'd dump the stock into the market. I'd make the chart look pretty so you guys would come along like fish and eat it up. Right? After my heart attack, that business kind of, working for people who, like I had one of my clients made what, $20 million in a week or 15 million in a week. And he stiffed the guy that was painting his fence $1,500. You work for people like that, and you're like, well, what happened was a friend of mine, after my heart attack, he said, "Why don't you come work for my software company and teach people how to trade?" Right? That's when I started meeting you guys. And I started hearing the stories of how you keep losing money over and over again. I spoke to a lady who took out a loan on her house and lost it all and had to move out of her house. I spoke to people who blew up their kids' college funds. I spoke to people who were borrowing money to trade and not telling their wives that they had lost their entire retirement savings because they were addicted to trading. I was like, this is something wrong here, right? I have always known that there's been suckers, but something inside me said, look, I got to try and help these people. And it's been rewarding, but god damn, it's been hard because people always try and argue with you, and they'd rather someone come along and steal their money than tell them the truth, right? It's really, it's really quite, it's taxing. And there's a lot of times where I'm like, Jesus, I just go do a deal, make a couple of $100 million and just blow out, right? But I've met a lot of really good people, and I've taught a lot of really good people how to make a little bit of extra cash every month so they can make their life easier. And worst case scenario, I can keep people from losing money until they start making money, right? Because all the trading educations all come and make 30 grand here, 40 grand here, right? Yeah, it's really hard, it's hard selling the truth. Like right now, there's no trade. Right? There's a little bit of a sell. It's going between 82 and 85, right? So this is the reason why I do it. This is the reason why we only charge $19. This is the reason why when I do lifetime mentoring, I charge people a certain amount and I mentor them for life. So it's not like I'm selling you a course and then I'm done with you, right? I'm selling you myself and my time, right? Why do I trade only ES? Because I like the ES. I'm 50. I'm an old man now, George. I'm old. I like the ES. I know the market inside and out. I make a little bit of money every day. I still do consulting for companies. I do mentoring. So I have income coming from different places. So the other thing too is at this age that I'm at and the stage of life that I'm at, I like the yes. I can go in, I can make some money. I know when to trade it. I know when to leave it alone. That kind of thing, right? It's a simple life. Ooh, there we go. A bit of liquidation. Nice. Looking for that 73.79 now. Right? A little bit of size came in. Right? I've had the Porsches and I've had the Bentleys and I've had, the trips in the private planes and, the 8,000 square foot house, and the wife who spent 100 grand a month on the Amex card like it was water. I've had all that stuff, and I know that's not what life's about. Sure, it's nice having $300 million offshore that nobody knows about, right? But there's also, I'm a person who loves to talk to people. I really like that interaction, right? Margin is higher. Thanks, Raj. I forgot to say that. And I've met some really good people having this room. Made some really good friends. Yeah, I just trade one market, right? I don't trade stock because if I'm going to get in the stock market, I'm just going to go and do a deal, right? They'll pay me 150 grand a month and give me a million shares for free, right? And I'll work on the company for a while, help the insiders sell all their stock. But I won't work on deals I don't believe in anymore. When I was young, I would just take on any deal. I didn't care what it was. What does the company do? I could care less. I'll just build a chart. I'll help the investors sell their stock onto the next deal. I do six deals a time. The POC is where the inventory is based. Do you know what a cost basis is, Foy? So if you buy 5 apples and you buy them for $1, your cost basis is $1. That's what that is. So the overnight POC is where the cost basis is. So we took this cheap crap, we sold it, and now we're bringing it back and putting it on sale. Does that make sense? Do you get that? One of the first lessons I'll teach you in the room is what inventory and cost basis are. Okay? So if you look at this chart, look at this little blue area here, right? This is the cost basis of the ES before the move up. Do you notice that we had a move up? Check this out. So this is where all the inventory was priced. So this is where you bought your oranges. Got it? Then we put our oranges for sale and we sold them all the way up here. Then we had to put them on sale, right? Because we ran out of buyers over 72.70. So we put the product, the oranges, on sale, and we came right back to the top of that cost basis, right? Cost basis is how much you paid for your product. You stop selling here, and look what happens. Boom. It brings in buying. So when you lowered price, you brought in buyers. It's like having a hot product. It's on sale. You lower the price. You put it on sale just for a day. And look what happened. It brought in buyers. Does that make sense? So the point of control, this blue crap here, that's the value area according to market profile. Basically, all the value area is the cost basis of that day. So 70% of the stuff is priced here. We took it and we sold it here, and we sold it here, and then we put it on sale. When we put it on sale, we were able to bring in buyers so we could sell it higher. So you see the path of inventory. Do you guys understand that? If you've ever worked in a store, if you were a kid and you worked in a convenience store, right? You worked at 7-Eleven or something like, they will have, like they're selling Coke and chips and chocolate bars, and they buy them at one price. So they buy the inventory at a price, and then they will sell that higher for profit. Now, what if nobody comes in? Well, then you have to mark it down. Sometimes you have to sell it at a discount to where you bought it. But that's how business works, right? That's when they have a going out of business sale, blowout sale. Do you guys understand that? Do these concepts resonate with you? Can you visualize it and picture it? Because the reason why retail traders don't make money is they're always trying to trade some crazy concept. And they can't visualize what's actually going on. And that's really important. Got to be able to visualize. Working out if they still want them to key. Yes, Dave. Yes. See, we had a little sale here. We put it on sale. What happened? It brought in buyers, right? So that's what our trades are based on. Our trades are based on the fact that when you put it on sale and it brings in buyers, you go with. If you put it on sale and it brings in sellers, then you sell alongside the sellers and short. Very simple concept. There's no rocket science in this, right? It's just simple, common sense business, right? Whether you're selling donuts or bagels or chocolate bars or weed or whatever it is you're selling, right? You're going to have an inventory of stuff. You'll have paid a certain amount for that. That's what the POC is, right? Now, market profile people, unfortunately, they make this shit so complicated and they use all these terms like value is increasing and value is this and the POC is moving up and just tell people that this is the inventory. This is how much we paid for the shit. This is what we're selling it for. Oh, now we got to put it on sale. When we put it on sale, did it bring in buyers? Okay, don't short it. Make sense? If you put it on sale and everybody starts selling and it brings in more sellers, right? Then you can short it and you can sell alongside those sellers until they stop, right? The concepts are simple. The execution is not. That's why we have a 5-step plan to execute and to build your discipline and to build your skills to get in and out. You know, like when those special forces guys go into a situation, they're not just like walking around with their going, oh my God, what do I do? What do I do? They've been trained, right? Just like a pilot, when he hits turbulence, doesn't go and grab the manual, right? You know, it's just a business, Dave. It's just a simple business, right? It's the acquisition and distribution of inventory. That's all it is. Now the thing is, it moves quickly and it's constant. So that's what really fucks people up. Excuse my language. It screws people up because they don't understand the simple concepts of business, and then they have to expand it to a thing where it's in motion, it's in constant motion. But the chart you are seeing, my friends, is a sales chart. So if I went and looked at this chart, it's telling you how sales are going. There's the open of Globex. There's the inventory, it's being sold, and then look at the distribution. You know, it's being distributed here for hours, right? And when you hold price steady, it brings in buyers, right? It's really sometimes it's so simple. Execution is not easy. That's why we train you. We train you, we train you, we train you so you can think clearly and act clearly. So you're not stuck in trades. Okay? Any questions? So if you want to learn how to do this with some common sense, come into our room, we'll help you. Guys in the room, you okay? You guys still awake? So for example, right now, there's no trade for us. So when you know that there's no trade, you don't waste money, you don't get stopped out, you're not jumping around. You wait for this edge or you wait for that edge, right? That way, you're not running around like a chicken with its head cut off looking for trades and getting stopped out all the time. You know, I remember I was in one trading room long before Trading Syndicate and Microfutures. You know, the guy who was running it is, I'm long, I'm short, I'm long, I'm short, I'm long, I'm short. He'd be down like 5, 10 grand before, before the day was even half over, right? This way you avoid that. You only trade when there's a clear business opportunity that you can manage your risk. When that clear business opportunity shows up, you take the trade. And we train you how to do that, right? And that's all you have to do. Make your money and get out, right? That's it for today, for our Friday, the 8th of May. Thank you guys. Really appreciate you being patient with me this week while I've been sick and the last couple of weeks. April was a tough month where I lost my voice, and it was difficult. And I appreciate the patience. So once again, come into our room. We're having that contest. You can win 5 grand. It's worth checking out. Barrier to entry is like 19 bucks, right? Thanks so much. Have a wonderful weekend. If I don't see you, I will see you Monday. And if not, now today's afternoon session, I just got a call from, I have to go and get blood tests done. So the afternoon session is going to be delayed until I get back, okay? They always bring me in like right at 3 p.m. So what I'll do is I'll do a little prep. Almost back to the radio voice. That's good. I'll do a little prep and put it out on Twitter, right? So you guys are prepped for the open, and I'll be back after the open, okay? Thank you very, very much. I really appreciate it. Have a wonderful, wonderful trading day, and we'll see you later on this afternoon. Thank you so much. Appreciate you guys. Have a wonderful weekend if I don't talk to you. Be safe out there. Bye for now.